Okay, good afternoon, ladies and gentlemen. May all of you in good health today. Welcome to our free morning briefing transfer pricing series. Tax and transfer pricing perspective in Australia and Indonesia. My name is Jelita Anggraini, transfer pricing assistant manager here in SS Consulting Indonesia. It is my honor to be a moderator for this webinar. First of all, I would like to welcome our speaker here from Crow, Australia today, AJ, Anthony, and Kit. We are very honored to have you all today. And we also have Gandhi, our TP manager here in Indonesia. Maybe we can have a short introduction too from our speakers today. AJ, shall we start with you? Please, the time is yours.
Thank you very much. Good morning, everyone. I'm AJ Janssen van Nibbenhuizen. I'm a senior partner with Crow Australasia, and I lead the transfer pricing business out of Sydney.
Yes, thank you.
And I might introduce myself now as well. So I'm Anthony Patrick. I'm a partner also at Crow Australasia. I focus on corporate international tax, and I've been now with the firm for around 18 months. Prior to that, spent a bit of time at Big Four firms, but happy to be at Crow now.
Thank you, Anthony.
You're on mute, Keith.
I'm so sorry. Hello, everybody. I'm Keith. I'm a manager in the TP team in Crow Australasia in Sydney. I've been with Crow for about a year, but prior to that, I have been for over 9 or 10 years in Big Four prior to Crow. But it's been great so far at Crow. Thank you.
Thank you, Kit. Okay. We'll start now, but before we begin, I would like to remind you regarding the rules during this webinar. First, before we begin, I would like to remind you to fill the attendance list by typing your name and company in the chat box. And all participants of this webinar are required to mute their audio speakers during the event to avoid background noise when the presenters deliver their materials. And there will be 30 minutes question and answer session. Participants may drop questions through chat box on Zoom here. And however, if you have questions during the presentation, you are always welcome to drop it anytime in the chat box, but we will read the question and answer it during the Q&A session. There will be no live discussion since the time is very limited now, and please type the question and also for whom the question is addressed. At the end of all session, we will need you to fill the client feedback form. The link will be sent to you shortly.
Thanks,
AJ, Anthony, and Keith, so the time is yours.
Thank you very much. I'll kick off. In the interest of sound and image quality, I'm going to kill my video feed in the meantime. Great, thank you. Julita, you can move to the next slide, please. And the next one. Perfect. Great. So broadly speaking, this is the agenda we're going to follow today. We're all going to be speaking in different parts of this particular agenda, so we'll be mixing it up between myself, Keats, and Anthony. And I think in the interests of time, given our slightly late start, we'll try and make up some time where we can as well. Thanks, Julita. Perfect. Great. Thank you very much. So I think the first point we wanted to talk to was the introduction of an expanded definition of the SGE. SGE stands for a significant global entity, and the specific relevance of this is that an SGE has additional obligations placed upon it. We'll touch on these obligations a bit later on, but it's just important to bear in mind that if you are an SGE, you do have specific obligations you need to fulfill. So as a starting point, the earlier definition of an SGE before the changes came in essentially had a situation where you have a global parent or a member of the group which had an annual global income of more than $1 billion Australian dollars. And that group specifically looked at what was consolidated for accounting purposes. So in the graphic on the right-hand side, you can see that we have a group structure. At the top, we have an investment entity, entity A. Underneath that is entity B and entity C. And to the right of that, we have entity D. So in essence, through that process, one can see that under the previous rules of an SGE, only entities B and entity C were actually considered to be significant global entities. Entity A was disregarded because it wasn't required to be consolidated for accounting purposes, and entity D was immaterial. So both entity A and entity D were specifically excluded because of either immateriality or because they were considered to be investment entities. As a result, only entities B and C were considered to be SGEs. Next slide, please. Okay, so what we now have is an expanded definition of a significant global entity. And the reason for the change was that there was the need to have a more consistent definition which would apply these SGE rules to a broader set of entities. So what it essentially has done is it's looked at these investment entities and it's introduced a broader concept which might include partnerships, individuals, trusts, private companies, investment entities, etc. And so what this effectively does is that it brings in these entities that were previously excluded into the broader definition of what makes up a significant global entity or an SGE. And that's largely based on the AASB 10, which is the Australian equivalent of IFRS 10. So the revised definition essentially looks at a global parent entity, and it still looks at a consolidated group with an annual global income of more than $1 billion Australian dollars, but it introduces this new concept, which is called an NLCG, a notional listed company group, and it broadens this definition to bring in anything sitting underneath this NLCG. And this largely affects groups which are headed up by unlisted companies, trusts, funds, individuals, partnerships, etc., that were previously not required to prepare consolidated global financial statements. So looking at the graphic on the right, the small little black boxes are previous definition of SGE. Only entity B and entity C were included. But now in this expanded definition, if we look at the yellow box, we have investment entity A as well as the small entity D being included into this broader concept of an SGE. Importantly, looking at the total annual income, what would be quite difficult to do is to establish whether you breach that Australian $1 billion threshold. And if you don't have specific financial statements prepared on a consolidated basis, it doesn't mean that you need to now go prepare consolidated financial statements at the investment entity level, but you would need to actually apply accounting principles in order to determine what makes up the billion and whether you exceed that $1 billion Australian dollar threshold. That's quite important, and these changes came into effect on or after 1 July 2019. So for income years starting on or after that specific date. So I think the main important point about this slide is this introduction of this new concept called the NLCG, the Notional Listed Company Group. It treats your top investment entity as a listed company in essence, and it now requires you to bring that entire group into the ambits of what is a significant global entity. The key issue here for consideration is control, and control is a very complex concept. It requires an element or a significant element of professional judgment, especially when you start looking at private equity, investments, wealth funds, superannuation schemes, fund managers, etc. And I think perhaps the biggest risk is these smaller entities sitting on the side, like Entity D, that in the past have been immaterial, but now are actually being included into this broader SGE concept, and it's important to not lose sight of these smaller entities. So just unpacking the NLCG concept a bit further, when looking at your listed company assumption, essentially you have to look at this broader group as if it was headed by a listed company. Importantly, you disregard the investment entity exception that's provided for in the accounting principles, and you also disregard the materiality exception. So even though your entity is really, really small, that entity would still need to be brought into this NLCG concept, which forms part of a broader SGE concept, which is now being introduced. Thanks, Jalita.
Thank you, AJ.
You can bring the next slide up, please.
Yes.
Thank you. Besides the additional obligations, these changes introduced by the ATO also introduced a new concept of country-by-country reporting group. So in the past, all SGEs were required to lodge your CVC statements and your general purpose financial statements. So this new concept has been introduced. Essentially is very similar to the NLCG. The key difference is that under this new concept of a CVC reporting group, you can essentially exclude the investment entities at the top, but your immaterial entities would still be included. And so again, similar to SGE, this brings on additional obligations for companies which would previously, or entities that would previously have been excluded from the concepts and the requirements of CVC reporting. So the graphic to the right explains it quite nicely. So if we start with the smaller little black box inside, that was our old concept of SGE. SGE only had your entity B and entity C, which was your old accounting consolidated group for accounting purposes. Then the introduction of the expanded SGE concept, so that's our bigger blue block, that brought everything in, and that brings in these investment entities, which, as I described, is quite broad. It covers individuals, partnerships, trusts, funds, etc. And then for CVC reporting groups, we've brought in the smaller group, which is essentially the cluster in the yellow box. So it excludes the investment entity at the top, which is excluded because of the CVC concept, but it importantly includes the small immaterial entities, which previously would have fallen by the wayside. The objective here was essentially to achieve a better alignment with the OECD guidelines under Action Point 13. And the important thing, this is also applicable from July 2019, so for income years starting on or after 1 July 2019. Thanks, Jalita. Next slide, please. So, importantly for the participants, what are the impacts of these new rules? Well, essentially, if you are now a notional listed company group, an LCG, under this expanded SGE definition, that company, so bearing in mind, we now have the investment entity at the top, which is included, as well as any immaterial entities. Those entities will have to apply the diverted profits tax rules. It also would have to apply the rules under the multinational anti-avoidance laws. And perhaps the biggest consideration here is that there are significantly higher penalties for SGEs. So up to $555,000 Australian dollars for any delays in submission of those statements. So that is a very material penalty regime, and it would be very important that these NLCGs, as well as any entities forming part of them, are cognizant of those particular obligations which they are now exposed to, which they wouldn't have been exposed to prior to the expansion of this SGE concept. The other important thing I want to maybe just point out is for those penalties, those are only applicable from the 1st of July 2020 if you were previously not an SGE. So if you only became an SGE under this new expanded concept, the penalties would only apply from income years 1 July 2020 onwards. So essentially you had a 12-month period to transition and get your affairs in order. Just on the CBC reporting group, so what that now means is if you form part of the CBC reporting group, so typically the entities that would most often fall into this group where they haven't fallen into a CBC group before would once again be those smaller entities sitting on the side. CBC statements now need to be lodged. You also need to lodge your general purpose financial statements. And importantly, something often overlooked is when we talk about CBC statements from an Australian perspective, that is a CBC report using the OECD template for CBC reporting. It includes a master file, which would be prepared under the OECD guidelines. And lastly, most importantly, the local file. And importantly, the local file is not your typical OECD local file. It is a local file under the Australian concept of a local file, which has significantly more detail than what a traditional OECD local file would have. Thank you, Jalita. Over to Anthony.
Thanks, AJ. I'll be talking now about the reportable tax position schedule. I might turn my camera off as well, as AJ did, just in case we have any difficulties. So the reportable tax position schedule has been a requirement now for a couple of years. It forms part of the income tax return that is lodged by tax-paying entities, and it essentially records, certain tax positions that are uncertain that an entity may have. Now, the schedule itself is quite detailed and it's quite a technical exercise because there are different categories to go through as part of the analysis, category A, B, and C, which I think is on the next slide, and I'll talk to that in a second. But these reportable tax position schedules can be used by the ATO to initiate risk reviews, depending on how the schedule is answered. Next slide, please. So there is an eligibility requirement that you need to consider first before you determine whether or not you have to complete an RTP. So companies with total business income of more than 250 million or more in Australia have to complete one. But also companies that are less than 25 million but are part of an economic group whose total business income is more than $250 million or more will have to complete it also. So what that means, what that could result in is, for example, you may have a private equity group which has an interest in an Australian company which only generates, say, $50 million in Australia. So on its own, you would think it doesn't have to complete an RTP schedule, but as part of the exercise, you have to determine what other interests the private equity group has. And if in aggregate it is more than $250 million, which in a lot of cases it is, because some of the private equity groups are quite large, but there's a lot of interest in Australia, then each of those interests would have to complete the RTP schedule, even though it is a lot less than, even though they have revenues of a lot less than $250 million. So that is a change which came out probably about a year and a half ago, I guess. And now it's like a self-assessment regime where you have to self-assess whether you have to complete the RTP. Before this, the ATO would notify you that you have to complete one, and that was mostly reserved to the large corporates in Australia, the big entities. Next slide, please. So as I mentioned, the RTP schedule is made up of 3 categories. Category A is is focused around positions adopted that are about as likely to be correct as incorrect. So, even 50-50 positions that have been taken in the tax return. So if you don't have more than 50-50, then you have to disclose that there's a tax risk. Category B is around uncertainty on tax payable or tax recoverable that are recognised in the taxpayer's financial statements or a related party's financial statements. So if, for example, there is a provision for tax that is booked offshore by the global parent, for example, and that provision includes, or there's an element of an Australian tax liability in there, then that needs to be disclosed as well. I have seen it before where it's happened like that, and that needed to be disclosed. It's rare, but it does happen. Category C is a list of 23 questions which cover a variety of different tax risks, and a lot of it is based on certain arrangements that the ATO does not like and that are published. So they have published quite a lot of these types of arrangements where they see there's tax risk, and if you fall within any of those arrangements, you have to answer yes to that question. There are also a lot of transfer pricing type questions in category C as well. So the schedule itself is really, like I said, looking at what are an entity's tax risks. A lot of the cases, there may not be any yes answers, but again, it depends on the taxpayer, and the ATO does use these forms as a point of reference in terms of who they want to audit in the future. Next slide, please. This is me as well. So another key sort of law change that has come into play over the last 18 months or so, or maybe 2 years now, Australia's hybrid mismatch rules. So these apply for income years commencing on or after 1 January 19. Essentially, these rules are trying to eliminate tax arbitrage opportunities or mismatches in the way in which one jurisdiction treats a transaction compared to another. So by way of example, there are various types of arrangements within the Australian rules that can be caught. These include, for example, deduction, non-inclusion mismatches, where there's a deduction in one jurisdiction but no income pickup or no taxable income in the foreign jurisdiction, or a deduction mismatch where there's a deduction in two jurisdictions for the same amount. Australia also has a targeted integrity rule, which is unique to Australia, because the hybrid mismatch rules are being implemented around the world, but the targeted integrity rule is unique to Australia. That looks at interest payments to offshore entities where the recipient is taxed at a rate of 10% or less. So that's one of the rules where Australia came up with that itself, and can be seen surprisingly quite often. Next slide, please. So just wanted to run through a couple of examples on this. So the deduction non-inclusion mismatch. Here in this example, we have an Australian company with redeemable preference shares with a foreign company. In Australia, depending on the way the redeemable preference shares are structured, ordinarily we can claim a deduction for those being a debt interest. So deduction in Australia, but in most circumstances that income is not taxed by the foreign corp. So going forward, something like this would be caught under the rules, and the rules would operate to basically deny Australia a deduction for that amount. Now, these types of arrangements with redeemable preference shares was quite common with private equity groups when they invest into portfolio companies. This was quite a popular mechanism to push debt down into Australia, claim an interest deduction, and not have any income pickup in the other jurisdiction. So effectively going forward, these types of arrangements don't really work anymore in Australia. Next slide, please. This example is a deduction mismatch where Australia is a PE of a foreign company, and it claims a deduction for bank interest, but because of the way that the foreign company works out its tax, it can also claim a deduction for the same amount because Australia is a PE and effectively it's a business unit of the foreign company. So there's two deductions there, one for the foreign company and one for the Australian PE. So again, these rules would operate such that, sorry, just got a screen pop up, that the Australia would deny that deduction for the Australian PE going forward. Next slide, please. So this is the target integrity measures that I mentioned before, where Australia pays an amount of interest to a foreign company, and that foreign company is taxed at a rate of 10% or less on that interest. This is, as I said before, it's unique to the Australian hybrid mismatch rules. There are some exemptions that can be considered to mitigate that risk. For example, in this slide, we have foreign company A and foreign company B. If, for example, foreign company B had the same tax rate as foreign company A, then it may be possible to claim the deduction goes the ultimate entity, what a tax rate is, where there's an exemption that will apply, but there are other situations where you simply can't get out of it. So if that's the case, the deduction would be denied in Australia. Next slide, please. So just a couple of the key takeaways on these hybrid mismatch rules. They're very broad in their application, and they're very, very technical and difficult to interpret. The other thing is, because it's a new law, there is very little guidance available. The ATO hasn't tested much of this in terms of providing guidance for taxpayers. Slowly it's coming out, but it's still a relatively new law. There's no grandfathering provisions, so there's no de minimis threshold as well, so it doesn't matter if your deduction's $100 or $100 million, the rules still apply. So the SGE concept that was mentioned by AJ before is irrelevant in this case. It applies to all taxpayers. There are a lot of disclosures that need to be made in the international dealing schedule, which accompanies the income tax return. There are 5 or 6 questions, I think, on hybrid mismatch rules and whether they apply, and if they do apply, which arrangement do you fall foul of, so that those items need to be considered when completing the return. And as I said, all multinational groups, it applies to everybody, so this is something that I'd strongly recommend everybody look at, especially all my clients. I'd advise them to look at these rules, even if they don't think it applies. Sometimes until you get into the detail, you don't really know. So the rules are very, very tricky and difficult to interpret at times. Next slide, please. Practical compliance guidance. I think this is for AJ now and Keats.
Yep.
I'll pass it back.
Thank you for that, Anthony. So I think as a starting point, the practical compliance guidelines, or the PCGs, essentially they provide broad law administration guidance, which address the practical implications of the tax laws and how the ATO approaches the administration of various laws. For purposes of our discussion today, we just want to focus more on the loans, PCG 2017-4, and those for inbound distributors. So just quickly at a high level, the loans PCG deals with all related party inbound and outbound loans, and the inbound distributors PCG addresses situations where there's a purchase of related party goods for resale in the Australian market, as well as the distribution or licensing of offshore IT type intellectual property. So those are the two really want to focus on today. Important at the outset, when looking at these particular PCGs and what taxpayers can do, there's various ways one can actually mitigate these particular risks and matters that come out of the PCG applications. That could be in the form of Australian transfer pricing documentation. If there aren't any TP policies in place yet, to actually design the appropriate policies and implement those and manage those going forward. Doing a PCG analysis or score. So typically, especially on the PCGs we're going to be looking at, there are sort of scoring systems introduced by the ATO which highlights particular levels of risk and how they would respond to that. So what we can assist taxpayers with is actually going through a scoring exercise to understand where the taxpayer might sit, and then obviously introduce the appropriate responses to those particular scores in order to reduce the risk, and then potentially, further reducing or mitigating those risks through applying for any APAs, applying for penalty remission, etc. Next slide, please. So the first thing we want to touch on is the issue for inbound distributors, and the particular PCG dealing with this sets out profit markers that the ATO will use to assess your transfer pricing risk for any inbound distributor arrangements. So importantly, this is a risk assessment tool for the ATO. These ranges that we've seen here are not any sort of safe harbors of any sort. So really what the ATO will use as risk markers. So in essence, what we have here, we have obviously different types of distributors, from general distributors, three categories of life science distributors, 2 categories of ICT distributors, and then motor vehicles. So in essence, if you're not into any of the 3 life science categories, ICT category or motor vehicles, you get caught up by general distributors. The broad concept here is that an Australian taxpayer would look at their 5-year weighted average EBIT margin, and it would compare that 5-year weighted EBIT margin to the profit markers displayed on this graph over here. And if you fall into either the red category, yellow category, or green category, would dictate as to how you are responded to, or how the ATO would approach your particular file or your particular matter with regards to this. So an important point here is that if, as a taxpayer, you are outside of the low risk zone, which is these green zones, if you are sitting outside that zone, so either yellow or red, you should give serious consideration to preparing some sort of proactive transfer pricing documentation to support your position, or consider doing an APA just to try and manage or reduce that risk. The ATO does make a specific point, and it acknowledges that these profit markers are general, and obviously one would need to give specific consideration to the taxpayer's facts, circumstances, profiles, risk issues, etc. So what they typically have acknowledged is that for all these profit markers here, it typically represents an entity which has a higher risk profile, and so the thinking is higher risk equals higher profits. But as we all know, under the OECD guidelines, the ability to make higher profits because of higher risk means you could also make losses. So the ATO does acknowledge that you'd have to look at the facts and they would look at the facts and circumstances of the actual underlying entity when actually looking or doing any further assessments. But this is the starting point from a risk assessment perspective. I have stressed these are not safe harbors or profit expectations. So the OECD doesn't expect you to make a profit of above 5.3% as a general distributor or an EBIT margin. But importantly, what they're saying is that if you're making less than 2.1%, you're into this red high risk category. They will almost certainly be taking a closer look at your operations, asking further questions, and then potentially going into a audit process. The red zone also would put you in a very difficult position to actually apply for any sort of pre-qualified unilateral APAs as well. So if you are in the red zone, you should be doing as much as you can as a taxpayer to either put together documentation which supports anything below 2.1% as a general distributor, or find yourself moving up towards the yellow zone to reduce that risk a bit further. Notably, we have a lot of different categories here, so maybe just to cover what these different categories are. Life sciences, as you can see, has your 3 subcategories, and these 3 subcategories essentially show an increasing level of activity that also incrementally generates value. So as an example, the category 1, you'll see that the expected, or not expected, the profit marker for a category 1 life science company, that deals with the distribution, detailing, marketing, logistics and warehousing of life science products. Life sciences products would include patented drugs, generic drugs, medical equipment, over-the-counter drugs, and any sort of animal health medications and drugs as well. So the first category deals with just the marketing, logistics, warehousing of those particular products. Category 2 would be everything included in category 1, plus any activities that deal with the approval, gaining market access or getting government reimbursements. So it's sort of an incremental value generation, sort of a stepping process. And the third one is everything included in life science category 1 and category 2, plus any specialized technical services. So broadly speaking, that's what the life science categories cover. ICT is very broad as well. It includes everything from hardware, software, IT solutions, applications, services, digital communication devices, very, very broad. And the category 1 for ICT deals with your sales and marketing, pre-sales, post-sales services, logistics and warehousing. Category 2 is, again, everything included in category 1, plus any complex sales processes, large customer relationship management, etc. So you can see the incremental value from category 1 to category 2 is not that significant, as we have seen in the life science categories. Motor vehicles are very broad. It covers anything to do with any motorized vehicles and the associated parts, so anything to do with distribution of motor vehicles and parts. And also the functions are very broad. So the obvious functions would be marketing, sales, after-sales support, transportation, warehousing, but it also covers issues around the insurance of motor vehicles in that value chain, administration, procurement, etc. And then under the general category, that covers everything. If you're a distributor and you aren't falling into one of these other categories, you'd fall into that general category. Next slide, please. So what this means is looking at the previous slide and then the various profit markers. If you fall into that low risk zone, medium risk zone, or high risk zone, the ATO set out what their likely approach will be to your particular file. So as you can see in the low risk area, they generally wouldn't allocate compliance resources. They'd be open to entering into APA discussions with you, and you could request a pre-qualified unilateral APA. Under medium risk, they would be monitoring your arrangements, using whatever data they have available to get a better understanding of your operations before they put resources into reviewing you. And again, similarly, they'd be open to APA discussions. And high risk would be the ATO would certainly pay far closer attention to what your activities are. They might enter into written communication with you, carry out active monitoring of your affairs, or go straight into the commencement of a review or an audit. The ATO would look at your global supply chain, the profile of your related parties and the amount of tax at risk, and obvious areas like consistent losses, etc., would make this issue more prevalent and would obviously get the attention of the ATO a lot sooner. Thank you. Next slide. Moving on to the other PCG, which deals with financial assistance. This goes into a fair amount of detail, so I'm not going to unpack all the detail in today's session, but the important points we want to put across here is that the PCG essentially again sets out a risk scoring approach that the ATO will use. So once again, it's a risk assessment for the ATO. It's a framework that it uses to assess the taxpayer's risks. These aren't safe harbors, and taxpayers importantly aren't relieved of their legal obligations to self-assess. Taxpayers still need to go through due process to assess that the position they're reporting is a market-related or an arm's length position. And the mechanics are essentially look at various indicators. It's split between outbound loans, inbound loans, and then the combination of outbound and inbound loans. And as an example there, that if it's not possible, or let's say in the column there you can see zero charge. So if you have an outbound loan where you've charged no interest, you pick up a score of 10. Further down, if the currency of the debt was not consistent with the operating currency, again you'd pick up a risk score of 10. If the company you're borrowing money to has a relatively poor credit rating, again you'd pick up a higher score. Moving to the other side of this particular matrix, for inbound loans, as an example, if your interest is particularly or a lot higher than what the cost of the referable debt is, so they're up to sort of 200 BPSs over the referred rate, you could pick up another 10 points over there. And through the whole process, you pick up these various scores, and at the bottom you have zones. So zone 1, 2, 3, 4, and 5. So if you've picked up 15 or more points in this assessment process, you fall into zone 5. So we might want to come back to this slide in a second, but Julita, we can go to the next slide quickly, please. Great. So the ATO has sort of a two-step process here. The first one looked around the credit pricing, and the second step in this process looks at the motivational risk scoring table. So this one particularly, you would look at certain characteristics of the debt structure, and you'd look at things like the leverage of the borrower. So if there's greater than 60% leverage, if your interest cover ratio is less than 1.4, the tax rate of the lending jurisdiction, if that's between 1 and 15%, it involves an arrangement covered by taxpayer alerts or involves hybrid arrangements, etc. All these push up the risk ratings. And so as an example there, if you go through the process and you pick up more than a certain number of points, you put into a particular category A, B, or C. So at the bottom left of this image, you'll see that if you've picked up more than 14 points, you'd fall into category C. So what we do is the ATO looks at the pricing score you picked up from the previous slide. So Julita, if we can just go one slide back, please. So again, at the bottom left there, let's assume that we picked up 8 points, so we'd be a zone 3. We can go to the next slide, please. Great. And let's assume that here we fell into category C, we had 14 or more points. We would then fall into the red zone. So we'd start on the 3 for pricing and the C for the motivational factors. We would then be into a red block, and that red block is very high risk. And in a case where there's very high risk, the ATO might proceed directly to an audit. If, however, we fell into, let's say, the amber zone, through the combination of the pricing rating and the motivational rating, that's considered high risk. Also would certainly attract a lot more attention from the ATO. And as you move down to blue risk and green risk, you obviously have a far lower level of risk. I think one of the broad comments from the ATO around factors that will assist you in this process and would certainly make their lives easier and yourselves in order to get a better position for defence. They certainly do recommend that taxpayers have agreements in place that include the key terms and conditions one would typically expect to find in a third-party financing arrangement. So they're not necessarily expecting a 100-page loan agreement, but they would expect an agreement to be in place which does deal with the specific key attributes that a third-party loan agreement would around the key terms and conditions of the loan. Thanks, Shalita. Next slide. Okay, so the particular PCG we've been talking about, 2017-4, has got different schedules attached to it, and Schedule 3 to this PCG specifically deals with interest-free loans on an outbound basis. So it takes a similar approach to sort of a risk assessment, and it applies to any arrangements that were in place or were entered into on or after 1 January 2020. So what the ATO will do is, on the previous risk assessment tables we were looking at, if you had an outbound loan that was interest-free, you automatically had a default rating of 10. So that will be the ATO starting point. So they will say that any outbound interest-free loan to a related party is high risk. It starts with a rating of 10. And then you do have the opportunity to try and reduce that risk rating. So one of the key sort of measures you would be able to do here is to argue that the outbound interest-free loan is actually more akin to equity contribution rather than a loan. So you take a two-step approach here. The first step is to look at these minimum required factors. And if you're able to answer positively to one or two, or let's say either of these scenarios, so on the left-hand side under step 1, if the rights and obligations of the provider of funds are effectively the same as the rights and obligations of a shareholder, or the parties had no intention of creating a debt with a reasonable expectation of repayment, and did not have the intent of creating a debtor-creditor relationship, if you can answer yes to one of those two, and you can answer yes to one of the following two, being the intentions of the parties are that the funds would only be paid and or interest imputed when the borrower is in a position to do so, or if the borrower is in a position where they have a questionable prospect of actually repayment and unable to borrow externally, if you can answer yes to one of those two questions. So you need to answer yes to one of the two questions on the left and one of the two questions on the right. So if you can answer yes twice, what you're able to do then is reduce your risk rating to only 3 points. And then there's a step 2, which looks at some additional factors. And if you're able to positively answer or deal with these additional factors under step 2, you could potentially take a risk rating down to 0. So looking at these various factors on the right-hand side, you need to go through the process, and it is somewhat more subjective sometimes, but you are able to do that. So I think the key takeaway from these risk-based assessments is that we would certainly advise taxpayers to go through these assessment processes on a proactive basis, understand what your position is, and put the necessary steps in place to mitigate those particular risks. What we have been able to help clients with in the past is where the ATO would have specifically put a client into a high-risk category, and through a more detailed, thorough analysis, we were able to point out and get the ATO to agree that a taxpayer sits in a lower risk area, which obviously gives them some room to breathe as well. Thanks, Julita. Next slide.
Thanks, AJ. I'll just cover off now some other developments, and also after these slides, there's a section on ATO activity in terms of how they review taxpayers. So the government has pumped a lot of money into the economy in terms of supporting businesses, and that figure is quite astronomical, as you can see from the slides. 257 billion and another 98 billion in economic support. Australia has very little cases of COVID at the moment. When these slides were prepared, there were none, but there was an outbreak yesterday in Brisbane. So Brisbane is now in lockdown again for the next 3 days. So despite that, I think the economy is going strong, and it's forecasted to grow at over 4% over the next calendar year, and employment is also expected to fall. There's a lot of investment in infrastructure, housing, technology, film production, manufacturing. The Australian economy is going strong at the moment, particularly with housing, and if you keep abreast of the news, our housing market is basically going out of control at the moment. It just keeps going up. There's a lot of demand for houses, but there's not enough supply, and that's pushing prices up quite a lot. In some areas, it's going up by astronomical amounts. There's obviously, as part of all that, there's a big increase in M&A activity, IPOs, etc. We have deep specialist ability to assist with this type of work. We have a corporate finance team, and we have highly trained professionals who do a lot of M&As. Next slide, please. Corporate tax rate is 30% for companies, and if you're part of a global group that's and your turnover in Australia, part of a global group where it's less than 50 million, there's this base rate entity rate which applies, and that's 26% for 2021, and then it drops again to 25% for subsequent years. There's been some discussion previously around reducing the corporate tax rate at 30% rate, but I don't think that's going to happen for a while yet. Next slide, please. ATO Review Programs. Okay, the ATO has a number of ways in which it reviews taxpayers, and it has different programs. It all started about 3 or 4 years ago when they reviewed the top 1,000, and that was called the Top 1,000 program. That's not on this. The Top 1,000 program focused on entities that have revenue in Australia of more than $250 million. That program is coming to an end because the ATO have basically almost reviewed all those taxpayers, and now they've moved on to other taxpayers, so top 500, next 5,000, medium and emerging private groups, and each of these programs cater for different levels of revenue, net assets, turnover, etc., and wealth. So they are all very different, but most of a lot of the other remaining taxpayers should fall into one of these categories where they have significance. The ATO can also, despite the revenue thresholds and the asset thresholds required to do this review, they can also review market leaders or groups that have a specific interest or have a specific type of business as well. So next slide, please. So as part of all these reviews, one of the key concepts that come out of this is I think I've already spoken about this, so we can probably go to the next slide. Yeah, this is the one I was going to. So as part of each of these reviews, whether it's the top 5,000, next 5,000, top 500, or emerging groups, etc., or even top 1,000, the review process is slightly similar, and it's obviously catered differently depending on the size of the organisation. But the key pillars for each review are what's on the slide now. So and those key pillars are tax risk and governance, ATO risks that have been flagged by the ATO to the market, significant transactions, M&A activity, etc., and accounting and tax differences. So the tax risk and governance framework really looks at does an entity have a tax risk management or a tax governance policy in place whereby it manages its tax risk? And the ATO like to see that that is documented by all taxpayers. Risks flagged to the market is, as I mentioned before, in the RTP schedule, the ATO have issued various publications to the market covering arrangements that they do not like. These are what are termed taxpayer alerts, and they cover all sorts of different arrangements that they see, or the ATO sees, that there could be perceived tax risk there. Significant. So if you fall within one of those categories, they will definitely ask a lot more questions around that. Significant and new transactions. So if an entity is involved in acquiring or selling businesses, they like to see how the gains are calculated on those disposals, and they also like to see, for example, how transaction costs are treated in Australia, and also, for example, how or the tax impact on the tax consolidated group. We have a tax consolidation regime in Australia, so when entities are acquired and disposed of, that has related consequences or tax consequences. So they like seeing the workings on that and how that was treated for income tax purposes. The last one is the accounting and tax variance. So they ask questions around the statement of taxable income. So you start at your accounting profit and then you make some tax adjustments to get to your tax payable. So they will review those adjustments. In some cases, they will ask a lot of questions around certain timing differences or permanent differences that have been applied in the statement of taxable income. So as you can see, it's quite a detailed review, the programs, and taxpayers normally get around 28 days from which to respond. You might think that that's quite a lot of time, but depending on what is going on in the organisation and how large it is, sometimes 28 days is not enough. So in a lot of cases, taxpayers do request an extension of time because compiling all this information does take a lot of time for a lot of taxpayers. Next slide, please. Just going back to the tax governance risk framework. So as I mentioned, the ATO is very big on documenting tax governance and tax risk policies. So they have issued a guide on this. It's a very long guide, and I've just taken a couple of points from there. So for example, there are various board level controls that they like to see, and there's also managerial level controls that they like to see documented. For example, in the managerial sense, they like to see that roles and responsibilities in respect to tax are clearly understood by all parties, that those processes are documented and there's a control framework in place. At the board level, they like to see that if there's a tax risk or if there's a risk flag to the market, that the board is appropriately informed of that. And there are a lot more. There's a lot more that needs to be considered as part of this. It's quite a long exercise to work through. But as I mentioned, the ATO is very big on this because the way they see it is if an entity has documented their tax processes and is fully across the tax risk at both the managerial and the board level, then that gives the ATO comfort that entity is managing its tax risk. If there is nothing in place, there's no processes, no one knows who does what, etc., then that's a red flag immediately to the ATO because that can lead to errors, mistakes, tax liabilities, etc. So they like to see documented processes, and if they do, they generally will, if it is a good documented process, they will leave you alone. But if you've got nothing, you can expect a lot more questions and a lot more reviews, activities in the future. Next slide, please. I think I've spoken about most of this already. So the significant new transactions around M&A activity and the alignment of tax and accounting outcomes again is your differences between the tax and accounting when you're working through your taxable income. I won't go into any more detail on that, given that we started late and we're almost approaching 3:30 now. So I'll move to the next slide. At the end of this whole process, the ATO gives you a rating, and fairly easy to follow: high, medium, or low assurance. High assurance means they're confident that you paid the right amount of tax based on their review. Medium is still a pretty good result in most cases, but there are some areas that they have concerns with, and they will note those down for you, and they'll probably follow you up on those concerns to make sure you've addressed them. And low is obviously where you don't want to be, where they have real concerns around your compliance around income tax laws. You can expect a lot more questions if you're in the low category. You can see there from the graph the spread across low, medium, high ratings that the ATO have given to the top 1,000 taxpayers, which was published in June 2020. So most taxpayers at the medium level. There are some low, and there's also a good percentage of high assurance where the ATO got comfortable. Next slide, please. I think this one is for Keats to talk to, and then she will go on to automation and transfer pricing to finish off the presentation. So I'll pass it over to you now, Keats.
Thanks, Anthony. So as Anthony just mentioned, there was a performance program report that was released by the ATO. And in this report, the ATO specifically stated that transfer pricing has been one of the main issues which they have seen in their reviews till date. And the ATO expects transfer pricing to also be a main issue in all its review programs in the future. Apart from the programs that Anthony just mentioned, like the programs that are based on your threshold and your revenue threshold, etc., the ATO also undertakes separate transfer pricing review programs, and how these entities are selected for a transfer pricing review is slightly different. In that sense, the ATO actually uses data and analytics to actually identify clients who are eligible for a review. So in that sense, the ATO already has numerous documents available with it, such as your income tax return, CBC statements, RTP schedule, all these documents that are already available with the ATO. The ATO actually extrapolates the information that's available in these documents and then identifies high-risk clients. So for example, we have had a client recently who was operating as a distributor in Australia. Now, based on the information that's available in the tax return and the CBC statements, the ATO by itself identified our client as a high-risk distributor based on the compliance guideline that AJ just discussed. So because our client automatically fell in the high-risk zone, they were reviewed by the ATO. Now, as a part of this review, obviously the first question that the ATO asked is whether we have appropriate TP documentation. Now, appropriate TP documentation might seem a little confusing, but what the ATO expects is that there is sufficient documentation supporting related party transactions. And this documentation needs to address the Australian TP regulations. Now, more often than not, we have clients who presume that they prepare documentation as per the OECD guidelines, and hence they already meet the relevant requirements. But the thing is, there are certain unique specific sections that are very specific to Australia. And if you have Australian specific documentation, these specific sections need to be addressed. Hence, what we're trying to say here is the ATO has numerous programs going on at the moment, which targets middle market, high-end clients in the market. So it's across the board. It's important that you self-assess, have things in order before the ATO initiates a review. Jarita, can we go on to the next slide, please? Excellent, thank you. The last section, which we will be talking about now, is automation and transfer pricing. This is actually a new initiative that we have initiated in Crow Australia. First of all, what is operational transfer pricing? OTP is actually the management, or rather the automation of the different TP phases, I might say. It aligns transfer pricing requirements with commercial goals. In that sense, what we're trying to say is there will always be a commercial goal to reduce your expenses. Now, if we automate certain processes in transfer pricing, then we can significantly reduce our expenses, our costs. Another thing that has driven companies towards automation is increased scrutiny. We have the ATO as well as other tax authorities across the world having access to a tremendous amount of information. Now, this information is from the CBC report, online lodgement of tax returns, etc. So globally, tax authorities are able to have a better picture of the group as a whole. So in turn, it becomes necessary for our clients to also have their policies aligned globally so that they're meeting their different requirements. Janita, can we just go on to the next slide, please? So in transfer pricing, what typically happens is most of the process happens at the end of the year, but the TP policies itself are actually set at the beginning of the year. We have transactions occurring throughout the year, and at the end of the year, we go back and first check if the TP policy has been applied consistently. And if we need to make any adjustments, it could be upward or downward adjustments. Those adjustments are made, those TP adjustments are made, and then the books of accounts are audited. Now, these books of accounts is used for various income tax and TP compliance. Janita, can we just jump to the next slide, please? Thank you. So in Australia, typically, our final books of accounts feeds into the income tax return, of course, as well as the different TP compliance. In that sense, the same information available in the final books of accounts is used to prepare the international dealing schedule. That's a very specific form in Australia. We have the CBC reporting statements that need to be prepared, and we also have the TP documentation that is prepared based on the information that is there in the books of accounts. Now, this new initiative or product that we have developed in Crow, for this purpose of discussion, I will be focusing only on the Australian local file. I think AJ slightly covered it partly earlier. In Australia, CBC reporting statements are covered as a CBC report, the master file, and there is an Australian local file. The Australian local file is completely different from the OECD local file. In that sense, it's an Excel sheet that's about 60 columns, so it's quite a massive sheet, and it requires extensive amount of information. So what we have seen is typically we have seen clients spend an immense amount of time just in identifying the right information that feeds into this Australian local file. So our product has been designed in such a manner that we pull the data from the client's ERP system and we automatically prepare the Australian local file. Can I have the next slide, please, Jalita? Thank you. So as I said, the process itself is that the product pulls the data from ERP system and spits out the local file. There are a few hoops that we kind of like jump through. First, obviously, the right information is identified from the ERP system. Now, what I'm talking about solely focus on the Australian local file. So there are very specific terms that are relevant only for the local file purposes. So for example, for the local file, we need to disclose the entity name, the related party name, the quantum of transaction, the transaction type, whether the transaction is denominated in AUD or in a different FX currency, things like that. So we first identify the right information, then we create a set of rules. So in that sense, we map the account numbers with the transaction type, or we identify who are the related parties, etc. So based on the rule sets that we create, the process just runs by itself, and then we have the local file that's prepared. Of course, the year one process is quite time consuming, naturally, because it's the first time we're looking at a client's data. But year two onwards, it's a much simpler process. Can I have the next slide, please, Jalita? Thank you. So as I said, in year two onwards, the process itself is much simpler in that sense. Obviously, the rule sets are just updated just to tweak if we have any changes in the business, for example, any new transactions, any new entities that are coming on board, etc., which is not much, which is not very often. So we just tweak our rules just to include such changes, and then the process runs automatically. So in that sense, our 60-column local file kind of gets compressed and prepared automatically, about 80%. So just the remaining 20% where it requires certain oversight or review, I would say, that's where we would need a little bit of time involved from the client's end. But otherwise, the whole process of collating the information and preparing the local file is completely automated. May I have the last slide, please, Jalita? Yeah, this one. Thank you. So obviously, the benefits of automating CBC reporting is your compliance costs reduce significantly. Because the process is automated, a lot of manpower, time, resources that are usually invested is removed completely. Of course, because the process is automated, there would be errors. The process is designed in such a manner that we have an accurate local file prepared, which aligns with the ATO's instructions. So there would be a minimal time required to review the file or even upload the file. So it's going to be a very seamless process. As I said, our entire discussion, especially on this section, is specifically only on the Australian local file. Our product can be tailored to prepare CBC reports, the global CBC reports as well, or even to determine the TP adjustments, the upward or downward adjustments that need to be prepared, need to be put through as journal entries. So all those different processes can be automated, and our product can actually address each of these requirements. It's just that for this purpose of discussion, I only focused on the Australian local file. That's it from my end, Jalita. Thank you.
TP audit will be presented by Gandhi. Gandhi, the time is yours.
Thank you, Angie, Anthony, and kids for presenting about the transfer pricing in Australia. It's very interesting, and we can see also several common ground with the Indonesia transfer pricing practice. And my part will just be brief. I know for the audience that it's just half an hour to lunch, so I will not take a lot of your time because the discussions is pretty similar with the Australian transfer pricing practice. In Indonesia, we also have similar indications for high non-compliance, which will be the target of tax audit. So this indication is regulated in the Indonesian Tax Office Letter number 15, year 2018, about the tax audit policy. So the purpose is to improve the tax audit practice in terms of the quality, the selection of the taxpayer, and also to improve the tax income of the tax office. So what the tax office would review to identify whether our company is indicated as a highly non-compliance is first to check whether we have any transactions with subsidiaries or entities located in lower tax jurisdictions. For example, for companies who are domiciled in Indonesia and we have a transaction with company related party in Singapore, where the tax rate in Singapore is 17%, lower than the tax rate in Indonesia now, which is 22%. This can be the first indication that our company would receive like questions from the tax office related to the transfer pricing. And the next point that they will check is whether our company have a significant related party transactions of more than 50% of the total transaction. So for example, if our sales total is 100 and we have sales to related party of 60 and to independent party of 40, this will also become a flag to the tax office. Which will identify that our company requires further scrutiny from the tax office. The other indications is related party transactions with group members in Indonesia that have a loss compensation, or the next one is where our company have not been audited for the past 2 years. And the next point is similar, to the one that was presented by AJ previously, where the tax office will try to compare the profitability of our company with the benchmark of the same industry. And if they identify that we have a difference of more than 10% margin, it would be an indication of high non-compliance. However, unfortunately, there is no further details about the margin for each industry, which before for Australia, we can see a very clear indications for companies who have a low, medium, or high ratings. But in Indonesia, we do not have any guidance yet for that. Hopefully in the future, like our tax office can give a more clear guidance for this benchmark. And also the next indications is for the taxpayer who issue VAT invoice of more than 25% from the total tax invoice to customer who does not have any tax identifications. So these 6 are the main points that the tax office will review and will be the basis for them to decide whether they want to pursue further investigations in our company. And this slide here, we will discuss about the parameter of the transfer pricing risk. And this parameter is discussed in the Indonesian letter number SA50 year 2013 about the tax audit technical guidance on taxpayer with related party transactions. So after the tax auditor identify which company have a high non-compliant risk, then they would also check whether we have a high transfer pricing risk. And they will use several indicators, which some of them have already been also discussed previously. For example, is the first one. They will identify if the company have a significant of related party transactions compared to sales or operating profit. And also whether the taxpayer have related party transactions with counterparty in lower tax jurisdictions. This is also similar with the previous one. And for companies who have non-routine transactions and who just recently underwent a restructurization, this will also indicate a high transfer pricing risk and may trigger a further scrutinizations from the tax office related to our restructurization scheme. And if we also have a specific transactions, for example, intangible transactions like a royalty payment or license payment for a trademark or other intragroup and services and loan transactions, can also indicate a high transfer pricing risk from a taxpayer perspective. And the other points is if our company have a low net operating profit compared to the other companies in the similar industry, and especially if we have experienced losses for several years in the past may also trigger a transfer pricing audit in Indonesia. So the tax office, when they are reviewing our transfer pricing transactions, there are several sources of information that they will retrieve. The first is they will request a transfer pricing documentations, and they will review our financial statements as used by the taxpayer as a basis to prepare the annual income tax return. For example, especially the attachment 3A and 3B of our CITR, which consists of the related party transactions informations, and also the notes in our financial statements, which explains the related party transactions and our transfer pricing documentations, are the main source that the tax auditor team will review to assess the arm's length nature of our related party transactions. And the other sources that they can try to identify is from the equalizations of VAT return and other tax return, and also having a research on the data obtained from the account representative from our exchange of information as well, and also information from the previous tax audit or tax disputes, objections and appeal, and information from the CBCR exchange data. All of these informations will be analyzed and will be identified by the tax office to look for the transfer pricing arrangements within our group. And when we have a transfer pricing audit, the main disputes areas between taxpayers and tax auditor in Indonesia are mostly in the transfer pricing method, whether to select the CAP method or TNMM method, which is the most used method in Indonesia. However, there are some cases where the RPM, CPM, and PSM method are also considered to test transactions. And then a comparable company disputes, where the tax office try to find a different set of comparable companies and use that instead of the comparable companies that we use in our local file transfer pricing documentations. And also, if we use a segmented financial statement to analyze our RPT in the local file, the tax auditor would scrutinize, would have a dispute whether our calculations and allocation of the segmentations are accurate. Further, they will also check if we have service transactions, for example, management service or payment of royalty, then we would need to prove that the services exist, already happened in the year by showing the agreements, the invoice, or any corresponding emails and reports that we have that related to the services. And also we need to show that the services that we pay to related party are actually beneficial to our company, and it is not a duplicative service, essentially only to shift money to overseas. And also a common dispute area in transfer pricing is for services is the difference in the cost allocation method to calculate the allocation of cost from the service provider to the taxpayers. Right. So here is a summary of the transfer pricing audit procedure that the tax office would take. So the first at the top is the pros-based analysis, where the tax auditor will analyze based on our industry and the value chain analysis. And then further, they will analyze the related parties and transactions that we perform and confirm the transaction scam and analyze the financial report and the function, asset, and risk of our company. Further than the tax office, then we will perform comparability analysis. Everyone can hear me when in this slide, so I'll just repeat it. So in the transfer pricing audit procedure, there. Okay, yeah, let me share first. Yeah, just wait, hold a second. Sure. Okay, hopefully you can see my slide already now. Can someone confirm? Okay, yeah. So I'll just repeat explaining this slide because I'm not sure whether I was disconnected when I am disconnected. So in the transfer pricing audit procedure, the tax auditor first will have a broad-based analysis to look at the big picture by analyzing our industry and also the value chain of our company. Further, they will confirm our transaction scam and look into the details of the related party transactions and also analyze the financial report and the function, asset, and risk analysis of the taxpayer. We'll perform a comparability analysis and entity characterizations. There are 4 common transactions, related party transactions. The first one is the sales and purchase transactions. The tax auditor will do the comparability analysis by determining who are the tested party, perform a comparable search, and select the most appropriate transfer pricing method. And based on that analysis, they will establish an arm's length range and will make a correction to the sales and purchase transactions. And the second and the third transaction is the intra-group service transactions and the royalty or intangible property transaction. For the intra-group service transactions, there will be an additional test. It is the existence test and the benefit test. So in this test, the tax auditor would like to assess if the service transactions and the royalty transactions actually occurs and actually gives an economic benefit to the taxpayer. So the services should not be a shareholder activities, meaning that the activities is performed solely for the shareholder interest. For example, services related to consolidating the financial statements or services related to the shareholders meetings. This kind of services cannot be expensed as a related party transactions. And for another example is a duplication of service. For example, we already received similar services from other parties, and these services will be corrected. The tax office will make a correction for that kind of services. And the other types of benefits that the benefit test that the tax auditor will check, will assess. For example, the centralized service or the form of remuneration on all services. After that, the tax auditor then will determine the arm's length charge for the services. They can use direct charge method or indirect charge method by using an allocation key, and based on that, they will assess the arm's length compensation for that particular service. Similarly, for the intangible property, they will also first examine whether the intangible property is actually received by the taxpayer during that year, and it is actually also beneficial with that taxpayer. And they will also further check about the ownership of this intangible property, who actually developed it and who actually maintain and exploits this intangible property. And after that, they will make an analysis to establish an arm's length range to determine if our royalty rate is already arm's length. And the last transactions is the loan transactions. They will also check whether the loan exists actually, whether we actually receive loan from a related party, and also what is the loan utilization, what is the purpose of the loan, whether it's for the working capital or for the investment loan, because it will impact the interest rate for that particular loan. Then lastly, the tax auditor will also do a comparability analysis to determine the arm's length range of that loan transactions. Okay, thank you for the time. That is all my presentations of the Indonesian tax audit. I'll give it back to Jelita. Thank you for the time, Jelita. Good afternoon, everyone.
Thank you very much, AJ, Anthony, Keith, and also Gandhi for a very interesting and insightful talk today. Okay, ladies and gentlemen, may I thank you very much for your participation in this webinar. I hope you enjoyed the program. Please follow our social media to see the updates schedule of our future events. If you have further questions for us, you may find our contact on our website. Good day and have a nice day. Thank you, everyone. Thank you all.
Thank you.